Good afternoon, ladies and gentlemen. This is Brian Dewhurst with Uncommon Wealth Partners, bringing you your market update and Bitcoin briefing. It is the end of November. We have a lot to be thankful for. And yeah, we've got 1 month left in the market for 2018. S&P 500 year to date, 3.23. NASDAQ up 6.18. Dow Jones 3.31. Gold down negative 6.03. Bitcoin down 72.25%. Wow. Okay, let's jump into the charts. I'm going through kind of a traditional, kind of how I started the YouTube channel, series of charts today to just go back to where we started. This is the S&P 500 index, and wanted to show you here. See, we got our first red candle. Very kind of bearish historically. You can see red candles here. We don't have them that often, and it doesn't mean we're going to, the sky is going to fall. But they're definitely one of the first things we're looking for. Here they've led to a massive sell-off. Here they led to a massive sell-off. But even here, we had one isolated red candle, isolated red candle here. So it's not necessarily meaning everything is going down, but it's definitely something we're watching. The moving averages here haven't crossed, so that's positive. Still have a lot of green dots on our different time charts. And our momentum, there's no squeeze. These red dots are what's called the squeeze indicator. There's no squeeze, which is good in this sense with the red candle. And so let's just keep going. This is the other chart. We haven't shown this one in a while, but this one has not gone red. And this one typically turns red historically faster than the other one. So that's positive. And then this one I thought was incredibly positive too. I would have expected a little bit more convergence here than we have. And even when you look in like 2016, ahead of the election and all the uncertainty, we basically traded flat for a year and a half. Those averages were a lot closer to crossing over and touching than even where we're at now. And so still a lot of health and breadth in the market. This stuff doesn't happen overnight. And so that's kind of what we're watching. With gold, still negative trend, kind of pushed forward a little bit with instability in the market, but kind of just tracking about $1,200 an ounce. And then Bitcoin just getting trounced, hit a new low of 35.05 so for the year. So yeah, it just continues to look bearish. You see the squeeze down here. We're on a daily chart, but the other charts are on a monthly, so it's going to be a little bit more zoomed in here, but that's a massive squeeze and move to the downside, as we've seen as Bitcoin broke through 6,000, kind of the avalanche there. You kind of see the moving averages, how they've inverted in a bearish trend, and so that looks very problematic. The one thing I really wanted to highlight in this chart, because a lot of people are kind of like, what's going on? The last low of the stock market was March of 2009. That was the low point of the financial Great Recession. And so in that, you look at March of 2009 was in here, and that's where you see this is a 3-month treasury, and there's basically just the interest rate of it. And you just see it's coming down. Like the Fed is basically lowering interest rates to zero. And then from 2009 until 2016, the Fed basically kept rates at zero. And from there, we've had 8 Fed increases in interest rate hikes at the Fed funds rate. And we're due for another one here in December. The Fed is meeting at the end of the year. And Federal Chair Powell has just come out and said, basically, alluded to the fact they're going to keep rates, where they're at. They're not going to change them. And the market reacted positively to that. And then the other main thing that we're hearing in the news is this whole trade kind of war with China that Trump is instigating with these tariffs and trying to get them to come to the table because the way they manipulate their currency and the way our two currencies trade together benefits China quite a bit. And so the other thing that a lot of people think, well, why is the Fed raising rates? Well, the chart that I don't have on here that I at least want to highlight is that China is deleveraging from treasuries or from basically buying U.S. debt. A lot of other countries are dumping U.S. treasuries, which forces the Fed, because they've got to finance the federal deficits in our budgets, it's forcing the Fed to raise interest rates to attract new investment, because billions and billions and billions of dollars are not being bought in treasuries at such low yields. And so the Fed is having to raise rates to attract outside investors to these investments to fund our deficits. So you see on this chart this massive squeeze here that's building up, and then you kind of just see this upward trend in interest rates. The other thing that I want to overlay on that are these two charts. These are from S&P, Standard & Poor's. That is the buybacks. And so kind of this other part that's not shown on the chart, but what the S&P was saying, Standard & Poor's was saying, is about over 40% of the return in the stock market since the bottom of 2009 has been a combination of stock buybacks and S&P 500 dividends. And so a lot of things we talk about with our podcast, which is cash flow, residual income, well, dividends is a form of that. And dividends is a huge part of the S&P 500 return. You can see, up here, Q3, kind of the year got cut off, but Q3 2018, it's topping out at about $450 billion annualized, of value that it's kind of come up to. So in that, because interest rates have been so low for so long, we're seeing peak stock buybacks. And so GE's done this, General Motors has done this, Apple does this, as they take their profits and instead of investing, and I'm not saying they're not investing in their business because they are, but instead of taking all of that money and investing in their business or sitting on cash, Apple, I think, is a great example of this. They have issued a dividend, but they've also been borrowing money at about 2 to 3% and then buying back their own stock. And what that does is it buys up the supply of that stock and reduces that supply and is creating additional demand beyond what the market is, and it's driving their share price higher. And so what this chart is saying is, and why I showed you that chart on 3-month treasuries, is that as interest rates rise on the 3-year and as the yield curve, as it gets more expensive to borrow money beyond 3 months, so 10-year treasuries, that type of thing, as those rates go up, it gets more expensive for these companies to continue to buy back stock and use debt to buy back stock. And so with that, we could see a reduction in, and kind of what you see here in 07, 08, 09, even dividends went down dramatically. And then you had buybacks go down dramatically. And so when you have rates going up and the buybacks go down and the dividends potentially peak, you could have a lot of return in the S&P 500 kind of being washed away underneath your feet, so to speak. And so kind of lends to where the downside is looking a lot more probabilistic. But the market, in terms of its general position here around 2,700 on the S&P, it's at a very critical juncture. And so that's where you're seeing a sense of urgency with Trump and China to get this deal done. And you're seeing a very big reaction to the Fed Chair Powell with what he's doing with interest rates. Because if they raise interest rates again, a lot of people think the stock market is going to go down. So that's kind of what we're looking at headed into the end of the year. 2019 looks difficult compared to 2016, 2017, 2018. A lot of the tax benefits from Trump's plan is priced in. The stock market hit an all-time high this year. And so I think it's going to be harder and harder for it to continue to hit those highs. And that's what we're watching. And that's why we're shooting these videos twice a month to kind of bring you this information. So again, if you're concerned about your plan or want to talk, we want to have those conversations and how we're positioning people's money. But these are the things that we're looking at and that are affecting the market, and want to be bringing these to you proactively. So thanks for watching. We hope you had a great Thanksgiving, and we'll have another video ahead of Christmas, and then we'll touch base at the end of the year. Thank you, everybody. Bye. The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.